Okay. To be mindful of time, we're going to go ahead and get started. Welcome, everyone. My name is Edwin Ragas. I am the director at the NYU Wasserman Center for Career Development at the School of Professional Studies. Really excited to kick off today's Behind the Title session. Our team at the SPS Wasserman Center has been hosting programs to virtually connect you all with industry professionals across different industries. And today we've got a really special guest who works in real estate, who I'll introduce in a second. Today, our theme is focused on the title of Private Equity Real Estate Analyst. And the goal of this program and series is for you all to better understand this title's job duties and responsibilities, ways to be successful with this title, and also hear from the speaker, their career journey and how they got to be in this title. So how this is going to work is we're going to hear from the speaker for about 30-40 minutes, and then we'll open it up for Q&A with them at the end. If you have reactions or questions throughout the session, definitely feel free to engage with the speaker and with one another in the chat box. For the Q&A portion, at the end, we'll invite you to type in questions in the chat box, or you can go ahead and unmute yourself. So we also have a really simple session worksheet that you can use to take notes during or after the session. So what I'll do is I'll put the link to that in the chat just after we start. And what you can do is just make a copy of it and save it to your drive so you can type your own notes into it directly. So I'll put that in just before we start. Some best practices to keep in mind while we're in this space: please keep your microphones on mute when not speaking. Ask questions that are of general interest and help to the group. So you want to avoid questions that maybe are too specific to your personal situation, because this is also a group space. Be also mindful of how much time and space you're taking compared to other students in the room. We want to give others a chance to ask questions as well. Come from a place of seeking advice, insight, and information. And please also be respectful of the speaker's time. We request that you stay present and engaged, again, with cameras on if possible. And also, when we're chatting later, don't be shy, be confident, and take advantage of the opportunity. It's all just a conversation. And finally, we want to make sure that this space is kept safe and productive. We don't anticipate any disruptions or distractions, but if so, may be asked to leave the room, okay? And if you run into any tech issues or hiccups, thank you in advance for being flexible and understanding. And so with that, I'm going to turn it over to our guest speaker for today. We just need to do a quick host changing here, but give us a second and then we'll get started. So thanks again for being here.
Yeah, thanks for having me. Let me share my screen here. So, yeah, today, the topic is, private equity real estate, right? You want to be a financial analyst in private equity real estate. What are you going to be doing, right? What is that job, and what's your day-to-day life going to look like? How can you be successful in that? So I'm gonna walk you through that, and feel free to ask questions in the chat, as Edwin said, and I'll be trying to answer those questions as we go. So first off, what is private equity? So private equity essentially is ownership in an entity that is not publicly traded. Okay, so it's not like you can go buy a stock on a publicly traded market. These are, privately held companies, or privately held in real estate, privately held assets and investments in office buildings and multifamily developments. So that is what private equity is. There are basically two types of private equity. There's what I would say is traditional private equity, and then there's real estate private equity. So traditional private equity, if you go work for one of those firms, that is where you're going to be buying privately held companies. Okay, those privately held companies, generally, you're going to buy them because you think that you can go in there and you can manage it better, right? You can increase revenues, you can decrease expenses to increase the bottom line, the EBITDA. Okay, so traditional private equity is generally going to be traded on a EBITDA multiple. Okay, and so and it depends on the types of companies, right? So a consulting company may trade at a 2x EBITDA multiple, whereas a technology company, a software as a service company, it may trade at a 20x the EBITDA multiple. So again, you're buying it, and we're not going to get too much into the traditional private equity aspect, but generally, if you think about it as if you buy something at a 7x EBITDA multiple, your job, you're going to go in there, you're going to manage it, and again, increase revenues and or decrease expenses to increase your EBITDA. So then when you sell it, presumably maybe again at a 7x EBITDA multiple, you get to keep that profit. What we're really going to focus on today is real estate private equity. Okay, and so that's going to be buying and selling, real estate assets. Okay, so there's lots of different property types out there, and we've got hotels, condos, office buildings, retail, industrial, senior living facilities. You got marinas, you got land developments, you got single family homes. Anything that is real estate related is being bought and sold, by private equity companies. Okay, so if you go work as a financial analyst at a private equity company, you need to understand how they raise capital. Okay, this is very important to your business and you being a financial analyst. So there's basically two ways that your future company can do this. It could be they could raise capital on a one-off basis. Okay, and so that means that they go put contracts out, they put in LOIs, they tie up deals, they get under contract on deals, and they get accepted, and then they have a diligence period. Maybe that's 30 to 45 days of diligence period, and then they've got 30 to 45 days of to close on the deal, right? So they've got 60 to 90 days to go not only do the diligence on the the investment, but also they need to go raise the capital. Okay, and so that means that all of a sudden they are having to wine and dine and talk to their investors and tell them about this specific deal and why that investor should put money into the deal. Usually those firms that raise capital on a one-off basis, they have their investor list. Okay, maybe they're crowdfunding. They have their investors, and generally 95% of the time, all those investors, they're going to invest in the deal. Okay, but it's just a lot more effort from the private equity company to go talk through these hundreds of investors, talk them through these specific deals and answer their questions. Okay, the other way that they could raise capital is by raising a fund. Okay, and so a private equity fund is going to be a company that basically raises capital from investors, and they go out to their investors and they say, hey, we're going to go buy in this geography, we're going to buy this certain asset type. Here's our thesis, here's our track record, and then investors say, yeah, you go buy multifamily assets in New York. Okay, and now the fund gets commitments from their investors, and now the fund can go buy whatever they want that fits that parameters that they told their investors. So the investors are not giving approval on every single deal. Okay, and usually the fund they just have to give a 10-day, maybe it's a 10-day or a 10 business day notice for their investors when and if they want to call capital. Okay, and also if you have a fund with commitments from the investors, you can now go to a bank and you can get a loan on those unfunded commitments. Okay, so if you raise $100 million, a bank will give you a $25 million line of credit that you can draw on the same day. And so basically what all that means is a fund is a better buyer of an asset. Okay, so if you're a seller and you're picking between two offers, one person has to go raise capital and you're not sure if they even have the ability to raise capital, and the other one can close literally tomorrow, the fund is going to be in a better position. Okay, so if you go to a private equity shop and you're a financial analyst there, understanding how your firm raises capital is important, because funds are just better buyers. They will be able to close quicker. They will even be able to win deals at cheaper prices. So you're going to get better deals for cheaper if you are a fund, because if you're a seller, you don't want to select someone and then not be able to close on it. That's going to taint your deal, and the market will know that. And when you go pick your bridesmaid offer, it may be lower than what it was originally. So understanding one-off deals versus funds, and there's a lot of benefits to being part of a fund. Background on myself, I started my firm called 3E Management about 6 years ago. Prior to that, I worked at one of the 10 largest private equity real estate firms in the world called Rockpoint Group. I was at Rockpoint running their finance group for over 12 years. So I was essentially there from the beginning of the fund. They now have, I don't know, $75 billion of assets under management. They do a lot of deals in New York, kind of East Coast and West Coast. So I was there for 12 plus years, ultimately left there about 6 years ago, started my own consulting firm called 3E Management. And we underwrite deals for private equity firms. And we also do fund management. So, our clients will hire us to underwrite deals. And so I've got a team of 12 financial analysts who their job is to work in Excel, crank away on deals every day. We've got 200 clients or so. They send us deals every day. And essentially, we are an outsourced financial analyst for these private equity companies, because they either don't have the skill set to underwrite the deals themselves, or they don't have the time, right? So as an example, maybe they're a multifamily developer, but now they have a project that also includes, a hotel or office or retail, and they just don't know how to underwrite those different asset classes. So we, get hired to build these Excel models for them. So every single asset class all across the US, we did about 26 billion of transactions in the last 18 months or so. And so, so we just crank away in Excel. So, this is what we do. Okay. And so next slide, we do fund services as well. So essentially we the other half of the business, which is maybe less relevant to what we're talking about today, but private equity funds, we basically are the CFO or the chief operating officer of these funds. We manage all of their cash liquidity, work with their asset managers, work with their deal teams, work with their financial analysts on projecting out the returns and projecting out the gross and net spreads, helping them with their investor questions and things like that. So basically managing the funds so the funds can focus on doing what they do best, which is raising capital, finding deals, executing the business plan. Okay. So what does a financial analyst do in private equity, right? So there's basically two types of jobs. Okay. First job is that, you might be an underwriter. Okay. And so this is what most people think of when you think of a financial analyst in private equity. Okay. So if you are underwriting deals, that is basically what you are creating Excel models. You are evaluating potential acquisitions and developments. You're analyzing capital needs and essentially coming to the answer of should you invest. Okay. So whether you work at a firm that raises capital on a one-off basis, or you work at a fund, you're going to have a mandate. Okay. They're going to say, yeah, we're looking at these geographies. We're looking at this return profile, i.e. what risk profile you're looking at. And so you'll be underwriting deals to a certain IRR. Okay. And you will be, creating these Excel models and basically trying to figure out at what purchase price should I or can I acquire the asset to achieve my desired IRR. Okay. So This is all you creating the models. And part of the underwriter's job, usually you're going to be divided up by geography. So for example, at my old firm, I did acquisitions in Silicon Valley, California, and I did acquisitions in DC, Northern Virginia. And so those were my geographies. So you're probably going to be geographically focused as a financial analyst. And the reason you do this is because you need to know the markets that you are investing in. Okay. You need to know what rents are. You need to know every building that is on the market or that is about to be on the market. Okay. You're going to be flying out there once a week or maybe every other week and meeting up with brokers, touring properties, walking the buildings, and just understanding what's going on. What tenants are out there looking for space, and what are the trends in that market and in that submarket. Okay, so and it's also important because you'll be networking with the brokers, right? So if you're a seller of an asset, you're going to hire a broker, and that broker is going to take it to the market and find buyers, right? If you are in good and have good relationships with those sales brokers, they're going to feed you the deals and say, hey, this deal really fits what you're looking for. Okay. So you're going to be flying out there, talking to them, going to lunches, going to dinners with them, walking properties, understanding the market. Okay. And that's also critically important because, you know, your job as a financial analyst is to underwrite as many deals as you can. Okay. And so when you are underwriting all of these deals, you know, you should know what your assumptions are. Okay. You know what market rents are. You know what the operating expenses are going to be because you're cranking away. You're underwriting 3 deals a day. Okay. And so in order to do that and be that efficient at it, you just need to know your market. Okay. And know what you underwrote on the last deal and on the deal yesterday and the deal last week. Okay. So that's an underwriter. Okay. The other job, and then I'll open it up to questions here. The other job that you might get as a financial analyst is going to be an asset manager. Okay. So an asset manager is someone who manages the asset after the acquisition. Okay. So the underwriter is going to go through the diligence, the building the models, and getting it to closing. Okay. Once it's actually closed, then some firms will then transition it to an asset manager. Okay. And the asset manager's job is to execute the business plan. Okay. They're going to be making the leasing decisions. Should you refinance the deal? Should you sell it? The CapEx projects, making sure the CapEx projects are done on time and on budget. Okay. And so that is what an asset manager does. An asset manager is, they're still going to be touring the properties, but they're going to be touring the properties that they're managing, right? They're not going to be looking at potential deals. They're looking at the deals that you actually own. Okay. And a big part of their job is they're managing the property managers. Okay. So you have property managers who are kind of the boots on the ground. They're the ones who are talking with the tenants and collecting the rents and meeting the elevator repairman to make sure that they show up on time and whatever things get fixed. Okay. The asset manager manages the property managers. Okay. And they make major decisions. So leasing decisions. They're going to have weekly calls with the leasing brokers, right? Understanding who's out there, who's leasing space. And if you get offers from tenants, running it through the financial model to understand, hey, should I take 25 cents less a foot in rent, but I get a 6-year term instead of 5-year term? Okay, understanding how that impacts the underlying, returns of the deal. And so, you're the one making all that. Yeah. Again, should you refinance? You're talking to the lenders, whether you're extending the debt or refining or selling, you're making all of those decisions. Now, important as you get into, interviewing at private equity shops, it's important to know, one, are you going to be an underwriter or an asset manager? But also, how do they have it structured? Okay. Again, some firms, you're an underwriter, You acquire the deal and then you're done. It gets transitioned to the asset manager. Other firms will have more of a cradle to grave mentality. So if you underwrite the deal, you then turn into the asset manager. Okay. My personal opinion is that that is a better way to do it. Okay. Because you know the asset and it eliminates any sort of finger pointing. So like, for example, if you're an asset manager and let's say the deal doesn't perform as well as you think, the asset manager is going to say, well, man, I managed this building as best I could. We just paid too much for it. Whoever underwrote the deal paid too much. If you're the underwriter, you're going to say, wait a minute. I got a great deal on the acquisition. The asset manager didn't execute the business plan and they didn't get rents, at the right price that I wanted them to get. So there's a lot of finger pointing if you kind of are in that structure where there's a transition. So my personal opinion is, the better way to do it is to have a cradle to grave approach. So yeah, okay. So we have.
Hey, Eric, can I just jump in with the question that came in? So with respect to underwriting, since you're exploring new markets and you have multiple deals at once, how much time is the right amount of time to allocate to each deal to be able to do justice to each of them?
Yeah, no, that's a good question. Like I said, you should be underwriting a handful of deals a day. Okay, and kind of the secret here is that let's say you're targeting a 18% gross return. Okay, when you go underwrite a deal, you're actually not getting all the way down to the levered returns. Okay, so don't worry about the debt. Okay, because essentially you should know or be able to figure out eventually that if you're targeting an 18 or 20 gross levered, that means I really need to get to a 10% unlevered IRR. Okay, so don't worry about the debt. If you're underwriting a deal and it gets to a 0 unlevered or a 5% unlevered IRR, by adding in debt, you're not going to get to your required return. Okay, so that's one little trick of how you can get through deals faster. I would think that, and a lot of deals that you're underwriting, you should know that whether it's a good fit for your mandate. For example, if you are trying to get to an 18 or 20% gross return, that's generally going to mean that there is some vacancy in the project, or there's a tenant that's about to roll to market and maybe they're about to vacate. If it is a 100% leased building at market rents, you're not going to be able to get to your 18%. That's just not a good fit. Okay, that's going to be a better fit for someone who's looking for a 10% return. Okay, so there's different risk profiles: core plus, value add, opportunistic, right? And all those have different return thresholds and different risk thresholds. So you should be able to very quickly analyze some of the deals and say, gosh, this one's 100% leased with long-term credit-worthy tenants. It's just not a good fit for me. Someone's going to be willing to pay more than what I'm willing to pay for because their return expectations are lower. Okay, but if you get into the financial modeling aspect of it, you should be able to underwrite a deal in a couple of hours. Okay, and the expectation, I would think, that you're at least going to be underwriting 100, maybe 200 deals for every one that you actually acquire. Okay, so your job is to, crank through all the deals that your broker contacts are sending you. Okay, and presumably if you go to a firm, they already have the broker relationships. The brokers know who they are. But even if it's a startup firm, once the market knows that you have money to spend in certain geographies and certain asset classes, they're going to send you deals. Okay, it's not that hard to get on a list to start receiving deals from brokers. So you're going to be getting a lot of deals, and you want to underwrite them as quickly as possible. At least discard the ones that aren't obvious fits, and then the ones that are close, underwrite it to an unlevered, 10 IRR. And how aggressive do you have to be to get there? Will tell you, does this go to the next level, and do I need to spend more time on it? But I would think a couple hours is what it's going to take. Okay, so what, in my personal opinion, what do you need to do to be successful as a financial analyst in private equity real estate? I kind of look at it as three different things. You need to know Excel. So Microsoft Excel, this is what you're going to be doing. You are day in, day out, spending all of your time in Microsoft Excel. Okay, so again, I've got a bunch of analysts. They spend 12 hours a day just in Excel. Okay, and so if you need to underwrite deals quickly and efficiently, you need to be quick and efficient in Excel. Okay, so that's going to be keyboard shortcuts, not using your mouse a lot, knowing the shortcuts, and also, knowing what formulas are better formulas to use. All right, and especially as you get bigger models, some formulas are slower than other formulas. For example, one of my favorite questions to ask in an interview is, what's your favorite Excel formula? Okay, and depending on the answer to that, that tells me a lot about their skill set in Excel. Okay, a common answer would be, I like H lookup or V lookup. Okay, that tells me something, right? Because in my opinion, index match would be a better Excel formula than H lookup or V lookup. Index match is able to do more things, and more importantly, it does it faster than the H lookup. So when you get bigger models, there invariably is the bigger the model, the slower it's going to be. So you got to be able to do things to speed it up. You also got to know finance, kind of the textbook knowledge of finance. So present value, future value, discount rates, IRRs, the interrelationship between all of those things. Because at the end of the day, when you are a financial analyst underwriting deals, your answer is the IRR. Okay, you are getting to a certain IRR, and you need to understand what an IRR is and the drivers of that IRR. Okay, and again, present value, future value, and time, and discount rates. So, and if you're an asset manager, you're valuing the assets on a quarterly basis, and so you need to know you'll be calculating the net present value, okay, which is essentially present value in that present value formula. So that is crucial to understand. And if you understand that, then you can now, at least in my organization, I can now foresee you becoming a senior analyst, right? You get the big picture, right? You're not just doing Excel formulas. You understand what's really going on, right? You understand where there may be issues in the model, or where there may be mistakes in the model, and you don't have to go look at every single Excel formula to figure it out, because you understand the big picture. You understand finance and what may be happening here, and then being good at modeling, right? So all of that, the combination of Excel and finance, you need to be doing. You need to be good at modeling. So those are the three things. I do have one of my other companies called Top Shelf Academy. We basically have a certification, right? So a real estate finance, private equity certification, right? So it's like 220 lessons, and it's going to walk you through all the Excel formulas you need to know to underwrite deals, and everything you need to know. So Top Shelf Academy, look it up. Take a look at that. But it will teach you. It's basically our own internal training, how I train my own analysts on Excel and finance and real estate. Just making it available to the public. So,
hey, Eric, can I jump in with a question too? So just on the modeling. So a lot of the real estate students here are exposed to financial modeling, right, in their classes and throughout the program. Can you touch a little bit more on what's the difference, right, between good financial modeling and great financial modeling? I think because they are already doing this work, what we hear sometimes is how to better position, their experience when they're talking about it in interviews, things like that.
Yeah, definitely. I think that yeah, and kind of where I was going to jump to here is what does a good financial model look like, right? Whether you are building your own template or you go work at a firm that has an existing template. I'll very quickly go through, we don't have a ton of time, we'll very quickly kind of go through what I think are kind of key things to have, right? So you need to have an investor summary. Okay, this is like a 2-page summary, right? If you work at a firm that raises capital every single deal, this is going to be like a summary that you send out to your investor base and says, hey, here's what this deal looks like. Do you want to invest? If you work at a fund, then you as a financial analyst, you are going to use this executive summary to present it to the investment committee. Okay, that investment committee are the ones who vote on the deal, and they say, yeah, should we do the deal or should we not? So you need a high level summary. The next thing that makes a good model is, having an error check. Okay, is the model broken? Did I add something on the monthly cash flows that I forgot to add on the annual cash flow? Does my sources equal my uses? Right, things like that. High level. Some people like to have the error checks spread around all throughout the models, but I'm going to forget to go to row 427 to check to make sure that error check is okay. So I like to have one summary place that you can very easily see, make sure the model is still functioning correctly. Another important thing that gets overlooked a lot is what I call like a model output page. This is basically there's no inputs in here. This is going to be pre-formatted tables and charts and graphs, because whatever firm you go to, you're going to be working with investor relations and marketing teams, and those investor relations and marketing people, they may not be experts in modeling. Okay, they may not be experts in real estate or finance. Right? You do not want them. You spend a lot of time perfecting your model here. You do not want your investor relations person to go grab the wrong number. Okay, you don't want them digging around your model and grabbing something that is wrong. Okay, so build outputs for them, so you can just say, hey, go to this one tab. I already got your formatted stuff. Just copy and paste it into your presentation. Okay, so that's key, which is also often underlooked here. Assumptions tab, obviously have most of your assumptions. You guys know, put them in blue and whatever, but have most of your assumptions consolidated in one spot. For a office, retail, industrial, you're gonna have a rent roll. For multifamily or senior living, you're gonna have a unit mix. So that's gonna be your room revenue, essentially, and you're gonna have a construction budget. If it's an acquisition, you would have a renovation budget. There's basically 2 ways that you can model a development budget. You either straight line the costs, or you can do a standard deviation S curve or Z curve, which some people like to essentially a bell curve to spread the cost out throughout the development period. And taxes are important to know, because you cannot just look at the historical 12-month, trailing 12-month tax expense, because the county has assessed your project at presumably something lower than what you're buying it at. Okay, so if it's raw land and it's a development, the county is assessing the raw land, but you're about to spend millions of dollars to develop something. And so the county is going to know that, and they're going to increase your tax assessment. Okay, and which is in turn going to increase your year 1 tax expense. So don't just look at your trailing 12 taxes and grow it at a 2.5%, 3% inflation, because you're going to miss right off the bat. You're going to miss there. Generally, I would say you should target anywhere from 65 to 75%, maybe 80% of your purchase price and or your development cost. That's what the county is going to assess you at. So that's a good estimate for what your taxes are going to be. All that rolls into a monthly cash flow. In my opinion, every model should be monthly. If you see an annual cash flow, that's probably not going to be very accurate, right? Obviously, we have an annual cash flow that sums up the monthly, but you need to know your monthly cash obligations and cash in, cash out on a monthly basis. not just on an annual basis. And obviously there's a waterfall, which is basically a waterfall is going to be the split between the LPs, which are your investors, and the general partner, which is you at the private equity firm, right? So generally a waterfall is the better the deal does, the more money the private equity firm makes. Okay. So, at the end of the day, a private equity firm may get 20% of profits above a, 15% IRR or above a 10 IRR or something. And so that is essentially how the private equity firm that you go to makes money, right? So they get they get asset management fees along the way, but that just kind of covers the bills. Where the real money is made is in promote. Sometimes it's called carried interest, and basically that is the disproportionate share that your firm, your private equity firm, receives in profits if the investors get their returns back. So that is where it makes. And just as an example, if you have you go to a firm that has a $2 billion equity raise, you're probably going to get call it 300 million promote, and that 300 million of promote is shared among the employees, right? So if you're probably not as a financial analyst, but if you stick it out and rise to a more senior level, you would get shares where they're called points of those promotes, and that's where the golden handcuffs, where you really get motivated to stick around, and you get motivated to buy good deals and make money for the private equity firm because you get a piece of it. So with that, I think we're running out of time. So I will open it up for I guess any questions. I see some questions here in the chat.
Yeah, Eric, could I ask you to stop your share, and if you could, I'm going to reclaim host. Okay, so let me do that. And there are a few questions that came in already. I do want to give folks an opportunity to ask the question if they'd like. So Tommy, I know you typed it in here. Would you like to ask it? Or if not, I can jump in.
Yeah, can you hear me?
Yes.
Yeah, so this might be a very specific question to return outlooks, or return metrics, I should say. But what is like a generally acceptable return metric for IRR, like XIRR or just normal IRR? Or once you build it out monthly, it's like that formula of like 1 plus IRR divided by 12, square root 12 minus 1. So I've noticed like when I modeled it out in classes, they tend to be slightly different. So I was wondering what's the most accurate way to, spell out those outputs.
Yep, that's a great question. Obviously, it depends, right? Really, what you're going to be doing is you need to be looking at the legal agreements, right? So your JV agreement or your limited partnership agreement, if you're a fund, and understanding what the definitions of IRR are in those legal agreements. I would say, kind of looking at your formulas here, if you have a monthly cash flow, let's say you're a fund and you just want to estimate, you have a lot of ins and outs that come in, maybe on a daily basis, but you just want to kind of aggregate those into a monthly model. I would do the 1 plus the IRR, raised to the 12th. That's what personally I use. For a waterfall calculation, generally you're going to be using an XIRR. I do not want to use an XIRR on a monthly cash flow. If I know the specific dates, then I want to use XIRR. If I'm aggregating a bunch of dates together and assuming a mid-month, convention, then I would use the, 1 plus the IRR raised to the 12th.
I see. Thank you.
Thanks. Disha, do you want to jump in with your question?
Sure. So with COVID, there's, we've seen a lot of creativity with respect to trying to attract businesses to buildings. And you said that, when asset managers, it's their job after the acquisitions have taken place, that they have to, explore what is the best way to, construct leases that is most beneficial to the firm in areas that they don't have much knowledge in, like, for example, in Silicon Valley or whatnot. because they're working in multiple deals at once in multiple areas. How are they able to come up with the best lease solution in a way which will allow them to, attract the best possible profit for the firm?
Yeah. So, I think I'll answer your question here, but if not, let me know. So, two things. One, the asset manager, doesn't necessarily need to understand the tenant's business, but you are going to be evaluating the financials of the tenant, right? And so, for example, when I was an asset manager on my Silicon Valley deals, a lot of times you have a subsidiary of a big company that wants to lease space in your building, right? So a subsidiary of Apple, right, in Cupertino wants to lease space. They're not going to put Apple on the lease, right? They're going to put the subsidiary name, which their financials aren't as good, and so you're basically you get to interview the tenants, right, and talk through the balance sheet, talk through the income statement, and understand, okay, well, what are they going to default? Ultimately, you got to make a decision. Are they going to default on my lease? Okay, what's the riskiness of that? Now, as it relates to specific spaces, yeah, you're going to be making decisions. A lot of times, you may have a building, and you want to hold out that building for a single user. Okay, man, I've got 100,000. I got 100,000 square foot building. Do I want to wait to try to find one tenant to take the whole building, or do I want to break the building up? Once I break it up, like for example, I remember a case where there was some tenant who wanted to come in and take 5,000 square feet. Once I do that, even if they pay me a great rent, that changes my whole business plan. Now I got to go find a bunch of $5,000-$10,000 tenant, 10,000 square foot tenants to fill the building, and that wasn't the original plan. But you got to react and know the market, right? Who out there could take 100,000 square feet? But once you break it up, you can't go find a 100,000 square foot tenant, right? They're not interested in taking the building anymore. So you as an asset manager are going to be evaluating that space, and obviously looking at kind of the flex spaces. You're going to know your building. You're going to know what space. They may have different rents, right? Your penthouse corner is going to have a better rent than the basement with no windows, right? So you're gonna understand that, and you could, as a financial analyst, how that impacts you is, if you're selecting kind of general vacancy, right? So part of your building, 7.5% of your building, you're going to assume is vacant. So a little trick, what you could do is say, okay, well, I don't want my top floor highest rent to be eating into the vacancy. I want to put that office, or I want to put that basement corner that's lower rent. I want to assign kind of my vacancy factor to that space individually. So those are kind of some things that you can do, again, as a financial analyst, kind of tricks of modeling to get you where you can say, yeah, we've got 7.5% vacancy, but it's going to be on the cheapest spaces.
Just a follow-up question with respect to that. So like what you just said, but that's in mostly in normal circumstances, right? Where when it was pre-COVID, that's one of the ways in which they would construct plans to know, to know how to get tenants in and which tenant would be the best suited for this particular building. But in now's time, when you have to really try to convince people to come, because most people because of flex space to work from home, they don't necessarily want to lease that much space or use it that way. How are you able to study what are the resources you use to study the market around you in that area to know whether this can be applicable to your specific asset or not?
Sure. Yeah, well, it's interesting that my office clients, I'm the CFO of a $1 billion office fund, and they would say that people are taking the same amount of space, right? So it's not like office tenants are taking less space. They're actually taking the same amount of space. They're just getting more creative with how they use the space, right? So a lot of which is kind of maybe what you're pointing at, is a lot more bigger spaces for the old school conference rooms don't really exist anymore. Now they've got couches and bigger TVs, and they can spread out more and have those conversations in different spaces, and open kitchens and things like that. So they're using the space differently, right? So, but you as an asset manager, you're involved in some of that discussion to the extent where they're saying, well, we need the owner of the building to put in X amount of dollars to redo the space, right? We need to put up an office wall here, put up a glass partition there, run the electrical differently. You're involved in that aspect. But as far as what the tenants, how they, use their space, as long as it's, within the guidelines of the building that you don't want them having a music studio disturbing all the tenants or whatever. The actual design and how they use the space is really the tenant's issue. And you're somewhat involved, but kind of on the outside.
Okay, thanks for that. David Welchman, I think Eric started to touch on your question a little bit, but I want to give you the opportunity to ask it or expand on the question if you'd like.
Yeah, so I just wanted to get your personal take on you coming into new market, you're not familiar with it. How do you start turning over stones to learn it and understand it and be able to effectively operate?
Yeah, exactly. You need to underwrite. You just need to start underwriting deals, right? So first step would be finding deals that are currently in the market or that have recently traded in the market, and then you start fine tuning your assumptions, right? So what I would do is say, all right, what just traded? Let me get that information. Let me underwrite it from scratch, and I know what it ultimately traded at. So how aggressive do I need to get with my assumptions in order to make that deal work? Okay, just with my base case underwriting, would it have penciled? Probably not, right? Most cases, you're gonna, as a financial analyst, you're gonna get in there and you're gonna say, oh gosh, ideally I want to assume X, Y, and Z. I want to be conservative and but reality is going to sit in and you're not going to be able to buy deals using conservative assumptions. Okay. And one of my clients came to me the other day and they were like, gosh, I can't, I'm not winning any deals. How do I start winning more deals? And so, I looked at his model and I was like, well, you're assuming this. And like, I can tell you, no one else is assuming that. Like right away, you're not going to win any deals because of that. But to answer your question, you just need to start underwriting deals and understanding how aggressive you need to be. And then, like I said, you need to go to the market. You need to get with the brokers, right? Start building those contacts and those relationships with the brokers. Start walking the properties and putting bids out, right? And then they're going to keep feeding you more deals for you to underwrite.
Okay.
Just if I could expand, just one follow-up. Are there resources beyond just the broker relationships, databases, places you go to sort of inform your data?
Yeah, I would say CoStar is kind of the main data provider. If you don't have any, realistically, if you have bought properties in the market, you have property managers, right? Or you're interviewing property managers to be your property manager in those markets. They operate other assets, right? So they're going to know, again, they're also going to know what rents are and what your expenses are. But for a technological solution, CoStar is what we use, right? A lot of our clients, they may not necessarily agree with what CoStar says that the rents are, and that's that is what it is. They're going to cherry pick their lease comps to make their story fit what they want to tell. But CoStar is kind of the thing to use.
Okay. We've got just under 10 minutes and we'll squeeze in these last two questions. Jacob?
Yeah. Hi, Eric. So I was just wondering I hear all the time Excel and Argus is like industry standard, what you should know as a junior analyst. I was wondering if there's any other technical skills that you think are either underestimated or becoming increasingly important, maybe in relation to like big data in real estate or any of that stuff.
Honestly, Excel. I know that's not the answer maybe you're looking for, but Argus, if I'm being honest, is pretty easy. You can learn Argus in 2 days. Excel, you're going to be working in Excel. And I realize that there are other software solutions. A lot of people are trying to do, cloud-based, especially like on the waterfall side. Hey, put in your assumptions and it'll spit out an answer. And maybe I'm old school, but I don't like that because I want to be able to get into an Excel model and trace the formulas and understand what you're doing and not just have a black box that spits out an answer that I cannot verify myself. Now, maybe a younger generation is more comfortable with technology, but right now in the industry, Excel is the way to go. As far as like, other technical skills, this isn't a technical skill, but I think, like I said earlier, Excel and then finance, right? If you understand finance, you can now, at least for my firm personally, I can now start putting you in front of clients, right? Because that's your next step, is to start talking to clients, start talking to the buyers or sellers or the brokers, and you understand what they're talking about. You understand the modeling and you understand the triggers of the model, right? So I think being able to talk to, in our case, clients and explain, the assumptions and explain, why the deal doesn't pencil, which they thought that it did. So being comfortable with your knowledge base to talk to clients, I think that's going to serve you well.
Thank you.
Okay. Anna?
Oh, hi, Eric. I just wanted to know, are there any particular resources to have like a reference of acceptable IRRs in different asset types and risk profiles, or is it like industry information?
Yeah, I assume there is resources out there. I can tell you right now, so basically all properties are going to funnel into a certain risk profile, right? So if you're an institutional investor, right, they're going to meet with their allocators, and the allocators are they're going to say, okay, you need to put stocks and bonds and whatever, and maybe 10% of their portfolio will be in real estate. Okay, and then once they dig down into the 10% of their total portfolio that's in real estate, now you start looking at, like I said, the asset or the risk spectrum is core. Okay, I would say core, you're targeting like an 8% gross IRR. Then you got core plus, which would be the next riskiest. That one you're already targeting 10 or 11 gross IRR. Then you've got value add. Value add, I would say, is a 15 or 16 target IRR. And then you've got opportunistic, which is an 18 to 22, 18 to 20 really target IRR. So all of your deals are going to be funneled into those different risk profiles. And just to hit on a little bit more, like a core asset, if you're targeting an 8, 9 gross IRR, that means it's stabilized, right? It's you don't need to put more capital into it. You've got long-term tenants, and then you just get riskier as you go out the spectrum, right? If you're a value add, if you're a value add company, you're going to buy something that's maybe it's 50, 60% leased. It needs more capital. You need to put money to redo the lobbies or the facade, increase rents. You need exterior, interior renovations. And then your goal is to stabilize it and sell it to a core asset. Okay. If core firm who wants an 8% IRR, if you're a value add firm who's targeting a 15% gross IRR, you do not want to sell it to another firm that's also targeting a 15% IRR, right? You don't want to sell it to another value add firm because that tells me that they think there's more value here, right? You really want to be getting in there as an asset manager, getting in there, stabilizing it, and selling it to someone who wants a lower return on that threshold.
Eric, I know I told you that was the last question, but another one just came in, and if you could take that. I don't know if I have the context to ask it. Do you see it in the chat?
Yeah.
It's from Rag.
Yeah, so
just repeat the question for the folks too.
Yeah, so the question is about kind of large private equity firms who want to invest large sums, do thematic investing, acquisition of real estate firms across different markets rather than acquisition of properties. We talk more about that kind of strategy. I mean, for sure. I worked at a large firm, right? They were raising $2.5 billion of equity for every fund that they did. And now you run the risk of like, gosh, I just raised 2.5 billion of equity and I have a certain amount of time, I have an investment period. Maybe that's 3 years, maybe that's 4 years. I got to go spend that money, right? And how do I spend that money? I cannot, you know, you as a financial analyst, you'll learn that the amount of work it takes to buy a $5 million property is essentially the same as it does to go buy a $200 million property. Okay, you still got to model it. You still got to do all your, checks and balances and make sure everything ties out there. So if you're a big firm, you're buying big deals, right? Because you don't want to be managing a ton of assets, right? So you will partner. A big firm is going to have programmatic investing. That's what they're called. So you're going to partner up with local operators, okay, and you're going to be the 95% money, 98% money, and your local partner is going to be the 5% or 2% money. That local partner, you basically have a right of first refusal on any deal that they do, okay, because you need to buy a bunch of assets, right, and you need people out there feeding you assets, and so you'll be working with your JV partner, and basically any deal that they do, you are probably also going to be buying into it as well. As far as like buying firms, maybe that happens. Usually they're going, I assume Blackstone is, I'm sure they buy up different companies that do this stuff. Generally, you're going to partner up with someone, right? You're going to have a firm that specializes in land development, okay? And then a big firm is going to say, oh, cool, yeah, I will give you $500 million to go do as many deals as you can. Okay, so they're not really buying them, but they're partnering with them, and the big firm, gets, they get the returns, and the firm that needs the money, they're going to get their returns as well. So it's kind of a win-win for everyone. But I see that a lot more often than buying companies outright. Now, granted, like someone like Blackstone, they raise $20 billion a fund or something crazy, so they need to do some drastic things, but they're definitely an outlier. I think the other big firms, they're just partnering with firms, and those firms feed them deals.
Okay. Thanks, Eric. So that's our time. But before we leave, Eric, can you just let the folks know how they can reach you, follow up, information about Top Shelf Academy?
Sure. Yeah. So Top Shelf Academy. If you go to the website, my email's on there. Feel free to email me, right? I like to, if you're looking, I know a lot of the private equity players out there. If you're looking to get a job at, one of those firms, happy to give my opinion, tell you what type of deals that they're doing, or if I've worked with them before. And if you get, if you're starting to do deals on your own and you just want a second set of eyes on the deals you're analyzing, feel free to send them my way. I'll look at it for free, no problem. I like to help where I can, help you get that job. And I guess one, on that Top Shelf Academy, we do have that certification. If you make it through the course and pass the certification, send me your resume. We have a resume book that I send out every quarter to private equity companies, all my clients and contacts, to let them know, hey, you should hire these people. So I want to make it as easy as possible, help you out as much as I can. So whether that's helping you land a job somewhere by taking this Top Shelf Academy certification, or if you just want to talk deals and you want to send me, hey, a friend of mine's looking at this deal, what do you think? Happy to give my thoughts. No problem.
Great. Okay, with that, thank you everyone for joining today, especially to Eric, our guest speaker. I did put a link in the chat to a very short survey if you could give us some feedback about today. We are going to send a recording of today's session to the participants, and also if you have classmates and friends and colleagues who couldn't make it today, let them know to reach out to us if they need that recording. So we hope you all enjoyed today's installment of Behind the Title. Be sure to check out the next one and other upcoming ones, which you can find all on Handshake. So have a good day, everyone. Thanks again, Eric.